All right, let's just jump right in. Welcome back to The Explainer. Today, we are putting a massive building materials giant under the absolute microscope. We're looking at Amrize, ticker symbol AMRZ. Now, this is a newly independent company. It just spun off from Wholesome. And right now, the market is completely divided on it. Is this a value trap just waiting to destroy your capital? Or is it a hidden, cyclical gem sitting right at the bottom of its cycle? Well, we are going to find out by putting Amrize through the ultimate valuation gauntlet. Here's the game plan for today. We'll meet Amrize, run it through the valuation gauntlet, uncover the red and green flags, do a guru reality check, and finally, deliver the final verdict.
So, part 1, meet Amrize. Let's look at the base stats. Before we can even try to value a business, we need to understand exactly what baseline numbers we're dealing with for this newly independent Wholesome spinoff. Just to anchor us, Amrize is currently trading right around $46.69 a share. But here is the context you need. That price means the stock is actually down almost 29% from its 52-week high of nearly $66. The market has absolutely hammered the stock lately, clearly pricing in some heavy cyclical fears.
But let's look under the hood, because this is not some tiny operation. Amrize commands a market cap of over $25.5 billion. And if you factor in their roughly $6 billion in debt, their enterprise value sits at almost $32 billion. They're pulling in a staggering $12.18 billion in trailing 12-month revenue, generating an EPS of $2.23. But notice that trailing PE ratio. It's sitting at 20.66. For a heavy, asset-intensive building materials company, paying over 20 times earnings is certainly on the higher end, which tells us expectations aren't exactly sitting at rock bottom.
Moving right along to Section 2, the Valuation Gauntlet.
We aren't just looking at one simple metric here. We actually grouped 21 comprehensive financial models into 5 different buckets to find the true, stress-tested fair value. Group A runs various cash flow scenarios, giving us a spread of $48 to $72. Group B looks at dividend models. These are hyper-conservative, dipping as low as literally $9 up to $48. Group C compares Amrize to peers like Vulcan Materials and CRH, placing it between $40 and $71. Group D gives us the hard, tangible, asset-based models, think liquidation and replacement costs, ranging from $12 to $50. And finally, Group E looks at aggressive real options, pricing in major capacity expansions and all that data center demand, stretching all the way up to $78 a share.
When we take a step back and synthesize the average of all 21 of those models, we get a blended intrinsic fair value range of $42 to $62 per share. So here's the absolutely crucial point. With the stock currently trading at $46.69, Amrize is sitting comfortably on the lower end of that fair value spectrum. For you as an investor, the math essentially says it's slightly undervalued. But before you jump in, we really need to know why it's priced there.
Which brings us to Section 3. Red flags, the bear case.
To understand why the market is discounting Amrize, we have to look at the fundamental issues that the mainstream media is just kind of glossing over. First, and most importantly, their return on invested capital is only 7.86%, which is actually below their cost of capital, or WACC. What does that mean? It means it literally costs them more to raise money than they make on it. They are currently destroying economic value. Return on equity is a pretty mediocre 9.72%. We're also seeing massive earnings volatility. I mean, they had a $592 million swing in net income just between Q1 and Q2. Add to that around $140 to $170 million in oil-driven cost inflation, eroding gross margins that dipped to just 9.7% in Q1, serious headwinds in residential construction, and a cash balance that has absolutely plummeted 62% year over year, down to $729 million.
If you read the headlines, the media narrative totally brushes this stuff off. They blame industry-wide inflation and seasonality for the messy quarters. But guys, the reality is far more concerning. What we are actually looking at is fundamental instability and company-specific gross margin erosion, and it's getting completely buried beneath these flashy revenue-beat headlines.
All right, but it's not all doom and gloom. Section 4, green flags, the bull case.
Despite those structural challenges, you have to check out these 7 seriously overlooked green flags. Management just raised their revenue guidance to between $12.5 and $12.7 billion. Why? Because explosive infrastructure and commercial demand are very real. Most notably, their distribution network gives them a whopping 90% reach into the North American data center market. They are primed to serve over 300 planned data centers. They also have a pristine balance sheet with a super low leverage ratio of just 1.7x. They're executing this Aspire savings program targeting $250 million. They just completed a massive 660,000-ton cement expansion, upgraded the roofing volume forecast, and here is the absolute kicker. CEO John Jenish recently stepped up and bought over 16,000 shares of his own company at $49.28. That is well above where the stock is trading right now. Once again, the media narrative completely misses the forest for the trees here. They view all this cost-cutting as boring, and they think data centers are only a play for big tech stocks. But the reality? AMRZ has massive, underappreciated infrastructure leverage, right into the heart of the AI build-out, completely supported by a rock-solid balance sheet that can easily weather the current cyclical storm.
Let's shift gears to Section 5, the Guru Reality Check. Would the legends buy this?
We're going to run Amrize through the exact frameworks of legendary investors to see if they would touch this stock today. First up is the father of value investing himself, Ben Graham. Graham loved tangible hard assets. But when we calculate the Graham number using Amrize's earnings and book value, we get $34.41. Furthermore, he demanded a PE below 15, and as we know, Amrize is sitting over 20. The verdict? Graham would definitely not buy. To him, the stock is currently overvalued by about 36%.
Next, we look at Peter Lynch, the absolute champion of growth at a reasonable price. Lynch famously said a fairly priced company has a PE equal to its growth rate. Amrize actually has a respectable expected EPS growth rate of about 8 to 10%, but when you stack that against a forward PE of 17, that leaves us with a PEG ratio, price to earnings divided by growth, of roughly 1.9. Lynch strictly preferred a PEG under 1.0. So, the verdict here? Do not buy. It's simply too expensive for the growth it offers.
Finally, Warren Buffett, a guy looking for quality at a fair price. Buffett would look at Amrize's cash flow and see an owner's earnings yield of about 5.9%. Okay, that's moderately attractive compared to Treasury bonds. However, Buffett demands exceptional capital allocators. With an ROIC of under 8% and an ROE under 10%, Amrize completely fails his strict 15% return thresholds. As Buffett famously says, he wants a wonderful company at a fair price. Amrize is more like a fair company at a fair price. The verdict? Pass.
And that brings us to the grand finale. Section 6, the final verdict. Is it a buy or a trap?
Taking all the data and those guru frameworks together, we first need to get real about their economic moat. Amrize operates with a narrow moat, derived entirely from two sources: efficient scale and switching costs. Look, building materials are highly commoditized. Literally nobody pays a premium for a specific brand of cement. However, Amrize is the North American market leader. Their massive scale makes it super inefficient for new competitors to try and enter, and construction contracts lock in their supply, which creates these really sticky switching costs. The moat isn't huge, but thanks to data center demand and capacity expansion, it is definitely slowly widening.
And that brings us to the ultimate math. Synthesizing all of our models, the blended intrinsic value for Amrize sits between $50 and $55 per share. Stacked against the current price of $46.69, Amrize is trading at a roughly 5 to 15% discount. It is fairly valued to slightly undervalued. You have a modest margin of safety here for a cyclical growth story. The market has absolutely already priced in the fundamental gross margin erosion and residential weakness, but it may not be fully pricing in those 300 data centers they're about to help build.
So, we end with this. The numbers say maybe, but the business quality says wait. Is this a classic opportunity to buy a cyclical stock at the exact bottom with 30% upside as infrastructure spending ramps up? Or is this a value trap where the return on invested capital just never actually recovers? I've shown you the entire valuation gauntlet. Now, as always, it's your turn to do your own homework. Which side are you on? Drop your analysis down in the comments below, and let's get the debate started. Thanks so much for joining me on this explainer, and I'll see you on the next one.